I built a $2 million real estate portfolio starting with just $14,000 while I was making minimum wage at a coffee shop. Think that's impossible? Most people do, until they learn about the strategy I'm about to show you. What if I told you that debt could actually make you wealthy? In this video, I'm going to demolish everything you thought you knew about real estate investing and show you exactly how to buy your first property with almost no money down and have your tenants pay for it all. The money myth: why you don't need a fat bank account to start. Imagine being told you need $80,000 just to get started in real estate. That's what most experts claim, but they're flat out wrong. This massive myth has kept countless people on the sidelines while the wealthy continue building their portfolios. Today, I'm going to blow this misconception wide open and show you exactly how to start building wealth through real estate without a fat bank account. Let's be honest, how many of us actually have $80,000 just sitting around? According to recent Federal Reserve data, the median American household has less than $5,300 in savings. Even more shocking, nearly 40% of Americans couldn't cover a $400 emergency expense without borrowing money. If we all waited until we had enough savings to invest in real estate the traditional way, most of us would never get started. And that's exactly what keeps the wealth gap growing wider every year. The rich aren't waiting around. They're using strategies that let them control valuable assets without tying up all their cash. They understand something that most financial education completely overlooks. In real estate, you don't need to own 100% of a property to control 100% of it. This is the magic of leverage, and it's what makes real estate completely different from other investments. Think about it. If you want to buy $400,000 worth of stocks, you need $400,000. But with real estate, you can control a $400,000 property with a fraction of that amount, or in some cases with literally $0 down. Every month you wait to start investing is actually costing you thousands in lost appreciation and rental income. The average home in America has appreciated about 5.4% annually over the past 30 years. On a $300,000 property, that's over $16,000 in wealth creation you're missing out on every year you sit on the sidelines. Add potential rental income of $1,500 to $2,000 per month, and you're leaving $30,000 to $40,000 on the table annually while trying to save up that mythical perfect down payment. Let me break down the difference between the traditional path and what I call the smart path to property ownership. The traditional path says, save 20% for a down payment, buy a single-family home, live in it for years, maybe buy another one someday if you're lucky. This outdated advice might have worked for our grandparents, but in today's economy, it's a recipe for staying stuck. The smart path understands that real estate is an investment vehicle, first and foremost. It says, use specialized loan programs to get in with minimal cash, buy properties that generate income, use that income to pay the mortgage, and then some, and repeat the process to build wealth exponentially faster. I'm not just throwing theory at you. My own real estate journey started when I was making just above minimum wage at my first job out of college. I had less than $7,000 to my name, student loan debt, and a beat-up car. But I discovered a strategy called house hacking that let me buy a duplex with just 3.5% down using an FHA loan. I lived in one unit and rented out the other, which covered almost my entire mortgage payment. Essentially, I was living for free while my tenant paid down my loan and the property appreciated. Within 18 months, that property had gained enough equity that I was able to refinance, pull cash out, and use it as a down payment on my next property, a fourplex that generated even more positive cash flow. I didn't need a huge bank account or rich parents. I just needed the right strategy and the willingness to take action. And I'm far from alone. Take Sarah, a teacher in Colorado who used a VA loan, one of the zero down options I'll show you, to purchase a triplex for absolutely nothing down. The rental income from the other 2 units not only covers her mortgage, but puts an extra $600 in her pocket every month. That's an extra $7,200 per year she's making while also building equity. Or consider Marcus, who worked as a delivery driver while buying his first property, a small fourplex in a working-class neighborhood using a 3.5% down FHA loan. His total out-of-pocket cost was just $9,800. The rental income from the other 3 units completely covers his mortgage, insurance, and even sets aside money for repairs. 5 years later, he owns 6 properties and was able to quit his day job. These aren't one-in-a-million success stories. They're everyday people who simply ignored the $80,000 down payment myth and used strategies that actually work in the real world. The truth is, there are legitimate, government-backed programs specifically designed to help people buy property with little to no money down. The banking industry doesn't advertise these programs because they'd rather you keep your money in their low-interest savings accounts while they lend it out at 5 to 6 times that rate. Let me give you a quick preview of what we'll cover in detail. FHA loans that let you buy with just 3.5% down. VA loans for veterans that require literally 0 down payment, and the little-known USDA Rural Development Loan that allows 0 down on properties in qualifying areas, which includes many suburbs, not just farmland. These programs aren't some sketchy loophole or get-rich-quick scheme. They're established government programs that have helped millions of Americans become homeowners. The difference is that most people use these loans to buy single-family homes they just live in, while savvy investors use them to buy multi-unit properties that generate income. The game changer is combining these low or 0 down payment loans with income-producing properties. This isn't just about having a place to live, it's about acquiring assets that put money in your pocket every single month while also appreciating in value. Think about the difference. The traditional approach means saving for years while housing prices continue to rise out of reach. The smart approach means getting in now with minimal cash, having tenants pay your mortgage, and building wealth through both cash flow and appreciation. What's holding most people back isn't money, it's knowledge. The wealthy aren't wealthy because they started with more, they're wealthy because they know strategies that the average person doesn't. And that's exactly what I'm sharing with you today. Good debt versus bad debt, the wealth secret nobody taught you. What if everything you've been taught about debt is actually keeping you poor? Growing up, your parents probably drilled it into your head that debt is dangerous, a slippery slope that leads to financial ruin. Stay out of debt, they warned. Pay off your credit cards every month. Save up and pay cash for everything. Sound familiar? Well, here's the truth that might shock you. The ultra-wealthy are doing the exact opposite. While middle-class families avoid debt like the plague, millionaires are actively seeking it out. And no, I'm not talking about maxing out credit cards on designer clothes or fancy vacations. I'm talking about a completely different approach to debt that could be the missing key to your financial freedom. The wealthy understand something crucial that most people don't. Not all debt is created equal. There's a massive difference between consumer debt and investment debt. Consumer debt buys liabilities, things that take money out of your pocket, cars that depreciate the second you drive them off the lot, clothes that go out of style next season, or gadgets that become obsolete within months. This is the debt your parents warned you about, and they were right. This kind of debt will keep you broke. But investment debt? That's an entirely different animal. Investment debt buys assets, things that put money into your pocket month after month. And real estate is the perfect example of this wealth-building debt. When you take out a mortgage on a rental property, something magical happens. Instead of you making the payments, your tenants do it for you. Every month, they're slowly paying down your loan balance while you maintain ownership of an appreciating asset. It's like having someone else buy you a winning lottery ticket every single month. Let me break this down with some simple math. When a bank approves a mortgage for an investment property, they don't care about your personal income the way they do with a home loan. Instead, they focus on the property's ability to generate cash flow. They're looking at the income potential of the property itself. This is precisely how investors like Matt Shields built multi-million-dollar portfolios starting with very little. Matt leveraged strategic debt to acquire multiple properties, using the income from those properties to cover the mortgage payments while building substantial equity over time. His tenants essentially bought the properties for him, all while he maintained control and ownership. What's even more fascinating is how banks actually create money through debt. When a bank loans you $300,000 for a property, they're not taking that money from someone else's account. They're essentially creating that money out of thin air, based on fractional reserve banking. They're allowed to loan out many times more than they actually have in deposits. So why do banks want you to believe all debt is bad? Simple. They want to be the only ones who benefit from this wealth creation system. They don't want competition from everyday people who understand how to use debt to their advantage. Here's what happens with a 30-year mortgage on a rental property. Let's say you buy a $300,000 property with a 30-year loan. Your tenants pay your mortgage for 3 decades. At the end, you own a $300,000 asset, which with modest 3% appreciation would actually be worth over $700,000. Completely free and clear. Your tenants literally bought you a property worth hundreds of thousands of dollars. But it gets even better. During those 30 years, you're collecting rental income above your expenses, putting cash in your pocket every month. According to the National Apartment Association, almost half of every dollar in rent goes toward covering mortgage payments. The rest covers other expenses and provides your profit. This means with proper management, you're making money now while your tenants buy you a valuable asset for later. This is the power of OPM, other people's money. You're using the bank's money, the mortgage, and your tenant's money, the rent, to build wealth for yourself. It's like having financial partners who do all the heavy lifting while you collect the rewards. Think about it this way. If you have $100,000 in cash, you could either Option A, buy one property outright for $100,000. Option B, use that $100,000 as down payments on 5 $100,000 properties, putting $20,000 down on each. With Option A, you own one property free and clear, collecting rent on a single asset. With Option B, you control 5 properties worth a total of $500,000. You've effectively quintupled your buying power through strategic debt. As these properties appreciate and as tenants pay down your mortgages, your wealth grows 5 times faster. Now, I'm not saying to go into debt recklessly. Strategic debt requires planning, careful number crunching, and proper risk management. But the point is that debt, when used as a tool rather than a crutch, becomes one of the most powerful wealth-building mechanisms available to everyday people. The wealthy don't fear debt, they harness it. They understand the difference between debt that makes you poor and debt that makes you rich. They know that while consumer debt creates a hole in your pocket, investment debt creates a pipeline of wealth flowing directly to you. I see this misunderstanding of debt keeping hardworking people stuck in financial mediocrity every single day. They save diligently for decades, trying to accumulate enough cash to buy properties outright, while investors who understand strategic debt are building massive portfolios with minimal starting capital. Let me be crystal clear. I'm not suggesting you load up on debt for the sake of it. What I'm showing you is a calculated approach used by successful investors to accelerate wealth building through real estate. The statistics don't lie. A significant portion of millionaires have built their fortunes through real estate, and almost all of them leverage debt to do it. This is why banks and financial institutions own so much real estate themselves. They understand that properly structured debt on income-producing properties isn't a liability, it's an asset. It's a wealth-building tool that creates both immediate cash flow and long-term equity growth. So the next time someone tells you to avoid debt at all costs, remember, they're giving you middle-class advice. And if you want middle-class results, by all means, follow it. But if you want to build real wealth, you need to start thinking like the wealthy. You need to understand that strategic debt, specifically on income-producing real estate, can be the rocket fuel that propels your financial future to heights you never thought possible. House Hacking 101. How to live for free while building wealth. While strategic debt on income-producing assets is powerful, What if you could hack the entire housing game by having someone else cover your living expenses from day one? This isn't some theoretical concept. It's a practical strategy I used to buy my first property while earning minimum wage, and it completely transformed my financial trajectory in under a year. Let me introduce you to house hacking, the ultimate financial shortcut for breaking into real estate with minimal money down. Instead of waiting decades to save enough for traditional investing, house hacking lets you start building wealth immediately while simultaneously solving your own housing costs. Here's how it works. You purchase a multi-unit property, live in one unit, and rent out the others. Your tenants essentially pay your mortgage while you live there, dramatically reducing or even eliminating your personal housing expenses. It's like having roommates, except you're the landlord and building equity at the same time. The beauty of house hacking is its flexibility. You've got multiple property types that work perfectly for this strategy. Duplexes give you one tenant neighbor, triplexes give you two, and fourplexes, my personal favorite, give you 3 income streams while you occupy the 4th unit. Don't have multifamily properties in your area? No problem. Single-family homes with basement apartments, converted garages, or even just spare bedrooms can work too. What most new investors don't realize is that multi-unit properties are valued completely differently than single-family homes. While regular houses are valued based on comparable sales in the neighborhood, multi-unit properties are primarily valued on their income potential. This creates amazing opportunities because most buyers aren't investors. They're looking for a single place to live. Less competition means better deals for you. Let me walk you through a real-world example of how powerful this can be. Imagine a standard duplex with 2 two-bedroom, 1-bathroom units. You could live in one side and rent the other to a small family or a couple of roommates. With average rents in many markets, that one rental unit might bring in $1,200 to $1,500 monthly. If your total mortgage payment is $800, you're only paying $300 to $600 for your housing, likely 70 to 80% less than what you'd pay to rent the same space. But the possibilities get even better with larger properties. With a fourplex, you could collect rent from 3 units while living in the 4th. In many markets, those 3 rental payments could exceed your entire mortgage. That means you're not just living at a discount, you're potentially living for free and generating positive cash flow every single month. The layout and design of these properties can significantly impact your rental income potential. Corner units with separate entrances typically command higher rents and attract better tenants. Properties with separate utilities allow you to transfer those costs directly to tenants, improving your bottom line. Even small touches like adding in-unit washers and dryers can justify rent increases of $50 to $100 per month per unit. What's often overlooked about house hacking is the psychological benefit. Many people are scared to become landlords because they worry about midnight maintenance calls or problem tenants. House hacking provides the perfect training wheels. You're right there on the property to keep an eye on things and address small issues before they become big problems. When a tenant reports a leaky faucet, you're just steps away to check it out. This proximity creates a natural accountability that often results in better tenant behavior. Living so close to your tenants also helps you develop important landlording skills. You'll learn how to screen potential renters, handle basic maintenance, and manage the business side of real estate, all while having a roof over your head that others are helping to pay for. It's like getting paid to learn a valuable skill set. The financial transformation possible with house hacking can happen astonishingly quickly. Consider this. When you're living for free or close to it, all the money you would normally spend on rent can now go toward savings for your next property. If you were previously paying $1,500 in rent, that's $18,000 per year, you can redirect toward building your real estate portfolio. Meanwhile, your property is likely appreciating in value, and your tenants are paying down your mortgage each month, building your equity automatically. Even in a modest appreciation scenario, you could be gaining thousands in net worth annually while dramatically cutting your living expenses. This one-two punch accelerates wealth building like few other strategies can. I've seen countless new investors use house hacking as their entry point into real estate. There's the young couple who purchased a duplex, lived in one unit while renting the other, and used the savings to buy their next property in just 18 months. Their tenants covered most of their mortgage, allowing them to aggressively save and expand their portfolio rapidly. Another huge advantage of house hacking is that it removes the artificial separation between investor and homeowner that keeps so many people stuck. Most people buy a home, tie up all their capital in it, and then wonder why they can't start investing. House hacking lets you become both simultaneously, using the same property and the same down payment. The strategy works in virtually any market too, from expensive coastal cities to affordable Midwestern towns. In high-cost areas, the savings are even more dramatic because the gap between your housing costs and market rents is typically larger. In more affordable regions, you'll often find better cash flow and more multi-unit options to choose from. What about privacy concerns? Yes, you'll have tenants nearby, but remember, this doesn't have to be forever. Many successful investors house hack for 1 to 2 years, build up savings and equity, then either move out to a separate property or buy their next house hack. It's a stepping stone, not a permanent lifestyle, unless you want it to be. The best part is that house hacking creates a natural progression into larger real estate investments. The experience you gain managing a small multi-unit property gives you the confidence and knowledge to scale up. Your first property becomes the FHA loan, your ticket to 3.5% down multi-unit properties. Building your real estate empire requires that crucial first step, but most people get stuck thinking they need a massive down payment. Let me share a game changer with you. The government will actually help you buy a 4-unit building with just 3.5% down through the FHA loan program. That's right. The same program your parents might have used for their single-family home can be your secret weapon for cash-flowing multi-unit properties. The Federal Housing Administration, FHA, created this loan program with a simple mission to help more Americans become homeowners. But here's what most people miss. The program doesn't just apply to cute single-family homes. You can use an FHA loan to purchase properties with up to 4 units, making it perfect for our house hacking strategy. Think about this. While everyone else is saving up 20% down payments for years, you could be building equity and collecting rent checks with just a fraction of that money down. This isn't some obscure loophole or shady strategy. It's a legitimate government-backed program specifically designed to help people like you get into real estate. Now let's talk about the actual requirements, because this is where things get really interesting. To qualify for that sweet 3.5% down payment, you'll need a minimum FICO score of 580. If your score falls between 500 and 579, you can still use the FHA program, but your down payment bumps up to 10%. Still way better than 20%, right? The FHA also looks at your debt-to-income ratio, which needs to be less than 43%. This ensures you're not taking on more debt than you can handle. But here's a huge advantage when buying multi-units. Lenders can actually consider the projected rental income from your other units when calculating your ability to repay. Typically, they'll count about 75% of the projected rental income to offset the mortgage payment. This means the rental income quite literally helps you qualify for the loan. Let's put some real numbers to this. Say you find a fourplex priced at $400,000. In many markets, that's totally doable. With an FHA loan, you only need $14,000 as a down payment. That's 3.5% of the purchase price. Compare that to a conventional loan requiring 20 to 25% down, which would be $80,000, $100,000 out of pocket. Of course, your monthly payment will include more than just principal and interest. Let's break down what a typical payment might look like. For a $400,000 property with 3.5% down, you're financing $386,000. At today's rates, your principal and interest payment might be around $1,900 per month. Add in property taxes, maybe $400 a month, insurance, $200 a month, and the required FHA mortgage insurance premium, about 0.8% annually for loans with a loan-to-value ratio of 95% or less, and your total monthly payment is approximately $2,500. The mortgage insurance premium is something to be aware of with FHA loans. Unlike conventional loans, FHA mortgage insurance stays for the life of the loan if you put less than 10% down. However, the benefits of getting started in real estate investing often far outweigh this cost, especially when you consider the wealth building potential. Now, for the exciting part, the rental income. Let's say each of the 3 other units in your fourplex rents for $1,250 per month. That's $3,750 in total monthly rental income. Subtract your $2,500 mortgage payment, and you're looking at $1,250 in positive cash flow every single month. That's $15,000 per year in your pocket, all while you're living in one unit essentially for free. And that's just the cash flow benefit. Don't forget, you're also building equity as your tenants pay down your mortgage, and the property is likely appreciating over time. These hidden wealth builders are working in the background, even if your cash flow was break even. FHA loans also have another huge advantage. The loan limits are surprisingly generous. In high-cost areas, the limit for a fourplex can be as high as $1,867,275. Even in lower-cost areas, the limits are substantial enough to purchase solid rental properties. These limits are adjusted annually, so they keep pace with rising real estate values. The property itself does need to meet certain standards. The FHA requires homes to be safe, sound, and secure. This means the property can't have major structural issues, dangerous electrical systems, or significant health hazards. This is actually a good thing for a new investor. It helps ensure you're not buying a money pit that will drain your finances with repair costs. One common question I get is, do I really have to live in one of the units? Yes. FHA loans require you to occupy the property as your primary residence. But here's the secret. You only need to live there for 1 year. After that, you can move out and keep the property as a pure investment, with all 4 units generating rental income. This creates a perfect stepping stone strategy. Buy a fourplex with FHA, live in 1 unit for a year while building landlording experience, then move out, rent all 4 units, and use your cash flow to save for your next property. Rinse and repeat. Some skeptics might say, but what if I can't find tenants? This is where location research comes in. Before buying, you'll want to verify the rental demand in your target area. Look at vacancy rates, aim for areas with less than 5% vacancy, and talk to local property managers about the rental market. In most areas, small multifamily properties maintain high occupancy rates because they provide affordable housing options. Look, I know the idea of becoming a landlord might seem intimidating, but remember, you're literally living on site for that first year. You'll be right there to address any issues quickly, and you'll learn the ropes of property management in real time. Many of my students report that the hands-on experience they gained during their house hack year was invaluable for scaling their real estate business later. Let me address another common objection. What if the property needs work? Here's a pro tip. Some of the best deals are properties that need cosmetic updates. The FHA will allow some renovation costs to be wrapped into your loan through their 203K program. This means you can finance the purchase and the improvements all in one loan, still with just 3.5% down. The math on FHA loans gets even better when you consider the long-term benefits. Let's say your $400,000 fourplex appreciates at just 3% per year below the historical average. After 5 years, your property would be worth about $463,000. That's $63,000 in appreciation alone, plus tens of thousands in mortgage principal paydown, all from an initial $14,000 investment. This is truly how everyday people build wealth through real estate. By starting small, using smart financing, and letting time and tenant payments work in their favor. I've seen teachers, firefighters, retail workers, and people from all walks of life transform their financial futures using this exact strategy. The VA loan, the ultimate zero-down investment hack for veterans. Those who served our country have been given an incredible financial gift that most veterans completely overlook. The VA loan isn't just for buying a family home. It's potentially the most powerful zero-down investment strategy in existence, and I'm about to show you why. While FHA loans offer an impressive entry point with just 3.5% down, the VA loan program blows it out of the water by eliminating the down payment requirement entirely. That's right, qualified veterans and service members can purchase properties with absolutely zero money down. And unlike the FHA program, VA loans don't require mortgage insurance, which saves thousands of dollars over the life of the loan. This combination of benefits creates an unmatched wealth-building opportunity that most veterans never fully leverage. According to statistics, the vast majority of VA loan users apply this benefit only to purchase single-family homes, completely missing its potential as an investment vehicle. Let's talk about what makes the VA loan such a game changer. First, the zero down payment feature eliminates the largest barrier to entry in real estate investing. Think about it. On that $400,000 fourplex we discussed earlier, you'd need $14,000 for an FHA loan. But with a VA loan, you could secure the same property with literally no money out of pocket. Second, VA loans don't require private mortgage insurance, PMI, which is mandatory on FHA loans and conventional loans with less than 20% down. This saves veterans hundreds of dollars every month compared to other financing options. That money goes straight to your bottom line, boosting your cash flow significantly. Third, VA loans typically offer competitive interest rates that are often lower than conventional loans. Even a small difference in interest rate can translate to tens of thousands of dollars saved over the life of a 30-year mortgage. To qualify for this benefit, you'll need to meet the VA's service requirements. This typically means serving 90 consecutive days of active service during wartime, 181 days during peacetime, or completing 6 years of service in the National Guard or Reserves. If you've worn the uniform, chances are you qualify. The first step in the process is obtaining your Certificate of Eligibility, COE, which verifies to lenders that you're eligible for a VA-backed loan. You can request this document through the VA's e-benefits portal online or through a VA-approved lender who can often pull it electronically in minutes. Many veterans don't realize how simple this process has become. It's no longer the paperwork nightmare it once was. Here's where it gets really interesting. Just like with FHA loans, you can use your VA loan benefit to purchase multi-unit properties with up to 4 units. The only requirement is that you must occupy one of the units as your primary residence. This means you can buy that fourplex we've been discussing, live in one unit, and rent out the other 3. Let's run through the numbers on our $400,000 fourplex example using a VA loan. With zero down payment, you're financing the full $400,000 purchase price. At current interest rates, your principal and interest payment would be roughly $2,000 per month. Add property taxes of around $400 and insurance of about $200, and your total monthly payment comes to approximately $2,600. Remember, there's no mortgage insurance with VA loans, so we don't need to add that expense. Now, if you're renting out 3 units at $1,250 each, that's $3,750 in monthly rental income. After covering your $2,600 mortgage payment, you're left with a positive cash flow of $1,150 per month, all from a property you purchased with literally no money down. That's $13,800 in annual positive cash flow, plus you're living for free in your own unit. If you were previously paying $1,500 in rent somewhere else, that's another $18,000 in annual savings. Combined, that's a financial impact of nearly $32,000 per year from a single investment that required no down payment. The funding fee is something to be aware of with VA loans. This is a one-time charge that helps sustain the VA loan program. The fee varies based on the type of service, whether it's your first use of the benefit, and the down payment amount, if any. For most first-time users, it's 2.3% of the loan amount, which can be financed into the loan. For subsequent uses, it increases to 3.6%. However, veterans with service-connected disabilities may be exempt from this fee entirely. On our $400,000 example, a first-time user would pay a funding fee of $9,200. While this may seem substantial, remember that financing this amount adds only about $40 to your monthly payment. a small price to pay for the privilege of purchasing with zero down and no monthly mortgage insurance. VA loan limits vary by county and are based on conforming loan limits set by the Federal Housing Finance Agency. However, it's important to note that there is no maximum loan amount for which the VA will guarantee, provided you have full entitlement. This means veterans with full entitlement can purchase properties well above the conforming loan limits without making a down payment, as long as they qualify for the loan based on income and credit. Let's talk about the long-term wealth building potential. Starting with zero down versus 3.5% down means veterans can enter the market immediately without saving for a down payment. This head start allows for earlier equity building through appreciation and principal paydown. For example, if property values increase at a modest 3% annually, that $400,000 fourplex would be worth approximately $463,600 after 5 years. That's $63,600 in appreciation alone. Additionally, after 5 years, you'll have paid down roughly $40,000 of your loan principal through regular mortgage payments, mostly covered by your tenants. So after 5 years, you've built approximately $103,600 in equity, $63,600 from appreciation, plus $40,000 from loan paydown, all from an investment that required no money out of your pocket. That's the power of leveraging your VA loan benefit for multi-unit properties. What's more, after the required occupancy period, typically 1 year, you have the option to move out, rent your unit, and potentially use your VA loan benefit again for another property. While there are some limitations and considerations with subsequent use, this strategy allows veterans to potentially build a portfolio of properties over time. I've seen numerous veterans transform their financial futures using this strategy. Take Michael, for example, a Navy veteran who purchased a triplex in San Diego using his VA loan. He lives in one unit and rents the other two for $2,100 each. His total mortgage payment is $3,800, leaving him with $400 in positive cash flow each month while living free. In just 3 years, his property has appreciated by over $100,000, and he's now looking at his second investment property. Or consider Amelia, an Army veteran who bought a fourplex near a college campus using her VA loan. By renting to students, she generates enough income to cover her mortgage and put an extra $800 in her pocket each month. She's using this cash flow to save for her next investment property, all while building equity in her current one. These aren't isolated success stories. They represent the untapped potential that most veterans are sitting on. While the majority of service members use their VA loan for single-family homes, if they use it at all, those who leverage it for multi-unit properties are building wealth at an accelerated pace. The USDA loan, the hidden zero-down program for suburban properties. You don't need military service to access zero-down financing. There's actually another government program that's been flying completely under the radar. Would you believe that neighborhoods just minutes from major shopping centers can qualify for rural loans with absolutely no money down? This overlooked strategy has helped everyday people buy homes worth hundreds of thousands without a single dollar in down payment. When most people hear USDA loan, they immediately picture farmland, tractors, and cornfields. But here's the shocking truth. The USDA Rural Development Loan Program has one of the most generous definitions of rural you'll ever see. We're talking about neighborhoods with Starbucks, Target, and all the suburban amenities you'd expect in a developed area. The government created this program to boost homeownership in less densely populated areas, but their definition of rural is seriously generous. I'm talking about areas with populations under 35,000 that aren't in metropolitan statistical areas. This covers thousands of suburban communities across the country that most people would never consider rural in the traditional sense. Let me show you how this works. If you pull up the USDA eligibility map online now, just search USDA property eligibility map, you'll see huge swaths of eligible areas highlighted in green. I've had clients absolutely shocked to discover their target neighborhoods, complete with shopping centers, good schools, and all modern conveniences, qualify for these loans. Here's the real kicker. These loans require zero money down. None. Zilch. You can finance 100% of the purchase price. And unlike VA loans that are exclusively for veterans, USDA loans are available to anyone who meets the income requirements. Speaking of requirements, let's break them down. First, there are income limits, which vary by county and family size. These limits are based on the median income for your area and are designed to ensure the program helps low to moderate income households. For example, in many counties, a family of 4 can earn up to 150% of the median income and still qualify. The second major requirement is that the property must be in an eligible area, which you can easily check using that online map I mentioned. Third, you'll need to use the property as your primary residence. This isn't for investment properties. Fourth, your credit score should typically be 640 or higher, though there's some flexibility there. What really sets USDA loans apart from other loan programs are the competitive interest rates. They're often lower than what you'd get with FHA or conventional loans. And while there is a funding fee, it's significantly lower than the mortgage insurance premiums required by FHA loans. This funding fee can be rolled into your loan amount, meaning you truly can close on a house without bringing any cash to the table. Let me walk you through a quick example. Let's say you find a nice 3-bedroom home in a qualifying suburban area for $250,000. With a conventional loan, you'd need to put down at least $25,000 10% or even $50,000 20% to avoid PMI. With an FHA loan, you'd still need $8,750 3.5%. But with a USDA loan, you can finance the entire $250,000 with nothing down. The application process is straightforward, but that does require some patience. You'll start by getting pre-approved with a USDA-approved lender. They'll verify your income, check your credit, and make sure you meet all eligibility requirements. Once you find a property, it will need to pass a USDA appraisal, which ensures it meets basic safety and structural standards. The timeline for USDA loans is a bit longer than conventional loans. Expect 30 to 45 days from application to closing, compared to the typical 30 days for conventional financing. This is because the USDA itself needs to review your application after your lender approves it, adding an extra step to the process. Now, let me share some real success stories that will completely change how you think about these loans. One couple I know was renting a 2-bedroom apartment for $1,800 a month when they discovered a 3-bedroom house in a nearby suburb qualified for USDA financing. They purchased it with zero down, and their monthly payment, including principal, interest, taxes, and insurance, came to just $1,500, saving them $300 monthly while building equity in their own home. Another client found an incredible deal on a short sale property in a small community just 15 minutes from a major shopping center. Not only did they get the home with no money down, but they also received a substantial credit from the lender that covered their closing costs. They ended up with a 3.875% interest rate on a 30-year mortgage and actually walked away from closing with cash in their pocket. This person had been saving for years for a down payment, but instead they used that money to furnish their new home and build an emergency fund. This program is particularly powerful for those who don't have significant savings. While conventional wisdom tells you to save 20% for a down payment, which could take decades for many Americans, the USDA loan lets you start building equity immediately without depleting your savings. I want to emphasize something important. These properties aren't out in the middle of nowhere. I've seen USDA loans used in communities just outside major cities, in college towns, and in growing suburban areas with all the amenities you'd want. The key is checking that eligibility map before you start your home search. You might be surprised at what qualifies. When you're looking at USDA eligible areas, focus on communities experiencing growth. These areas often see stronger appreciation over time, which means your zero-down investment can build equity faster. And since you're not putting anything down, your return on investment is technically infinite. The landlord nightmare myth, how to find great tenants who pay on time. Those infinite returns sound amazing, but there's an elephant in the room we need to address. I don't want to be a landlord is the single most common objection I hear from potential investors. That fear of midnight maintenance calls and nightmare tenants keeps countless people from building wealth through real estate. But what if I told you that with the right systems in place, you'll spend less time managing your properties each month than you spent watching this video? Let's be honest about what really scares people away from real estate investing. We've all heard the horror stories: tenants who destroy properties, midnight toilet emergencies, and renters who disappear without paying. These landlord nightmares get shared at every family gathering and plastered all over social media. But here's what nobody tells you. 95% of these problems can be completely prevented before they ever happen. The secret weapon? A bulletproof tenant screening process. This isn't just some minor detail. It's literally the difference between real estate being a wealth-building machine or a money pit. Think of screening as your financial force field. When done right, it filters out problem tenants before they ever get your keys. Let me introduce you to what I call the screening trifecta, the three-part system that virtually guarantees quality tenants. First up is the credit check. But don't just look at the score and call it a day. Look for what really matters: payment history and debt utilization. That tenant with a 680 score might look decent on paper, but if they have a history of late payments, that's a massive red flag waving in your face. What score should you look for? Data shows that tenants with scores above 650 are significantly more likely to pay rent consistently. That doesn't mean automatically rejecting someone with a 640, but it does mean digging deeper into their history. Remember, you're not just renting out a property, you're choosing a business partner who will be responsible for taking care of your investment. The second part of the trifecta is income verification, and this is where amateur landlords often drop the ball. Don't just take their word that they make about $5,000 a month. Ask for pay stubs going back at least 2 months. Call their employer to verify employment. Check their bank statements to confirm deposits match their claimed income. Here's a rule of thumb that saved me countless headaches. Tenants should earn at least 3 times the monthly rent. That means for a $1,500 apartment, they need to bring home minimum $4,500 monthly. This isn't being picky, it's basic math. If their rent eats up more than a third of their income, they're financially stretched thin. And guess which bill people tend to skip first when money gets tight? Yep, the rent. The final piece is the background check. This goes beyond just criminal history, though that's certainly important. You want to check for previous evictions, lawsuits, and even search for them on social media. You'd be amazed what people post publicly that they'd never tell you in an application. Now, I know what you're thinking. This sounds like a ton of work. It used to be, but nowadays technology has made this process almost effortless. There are screening services that automate credit checks and background investigations, delivering comprehensive reports within minutes. What used to take days now takes less than an hour. But tenant screening is just one piece of the puzzle. You also need protection through proper documentation. Your lease agreement isn't just paperwork, it's your shield. Make sure it clearly outlines maintenance responsibilities, late fees, and expectations for property care. Include clauses about noise, occupancy limits, and even specific instructions for things like garbage disposal or snow removal, depending on your property. A properly structured lease prevents misunderstandings before they happen. It gives you clear grounds for action if issues arise. This isn't about being a difficult landlord, it's about setting clear expectations that protect both you and your tenant. Next up is landlord insurance, and not just any policy. You need coverage specifically designed for rental properties. Standard homeowners insurance won't cut it. A proper landlord policy covers property damage, liability claims, and perhaps, most importantly, loss of rental income if the property becomes uninhabitable due to a covered event. This isn't the place to pinch pennies. The difference between a basic policy and comprehensive coverage might be $20 to $30 a month, but that extra protection could save you thousands if something goes wrong. Think of insurance not as an expense, but as buying peace of mind. Now let's talk about what happens after you've found those perfect tenants. Managing the property. This is where automation becomes your best friend. Set up online rent collection systems that automatically deposit payments into your account. Create digital maintenance request forms that tenants can access 24/7. Build relationships with reliable contractors who can handle issues when you're not available. With these systems in place, you're not chained to your properties. You're not rushing over at 11 p.m. because someone's faucet is dripping. You're building wealth while living your life. The average landlord with proper systems spends just 1 to 2 hours per month per unit on management tasks. That's less time than most people spend deciding what to watch on Netflix each week. Remember, being a landlord doesn't mean you personally have to fix toilets or chase down rent checks. As you grow, you can hire property management companies that handle everything for a small percentage of the rental income. The wealth building happens automatically in the background while you focus on what matters most to you. The truth is, real estate investing isn't about becoming a handyman or a collections agent. It's about building systems that generate wealth with minimal input from you. The horror stories you hear come almost exclusively from landlords who skipped these crucial steps. Let me share a quick example. My friend James was terrified of becoming a landlord. After months of convincing, he finally bought a duplex using his VA loan. He implemented the screening trifecta, set up automated systems, and guess what? In the 3 years he's owned the property, he's had exactly 0 emergency maintenance calls, 0 late payments, and spends about 45 minutes a month managing his property. Meanwhile, his net worth has increased by over $100,000 through appreciation and mortgage paydown. That's the reality of being a landlord when you do it right. Not midnight emergency calls. Not chasing late payments. Just steady wealth building while you sleep. From one property to many, the BRRRR method explained. Steady wealth building while you sleep sounds great with one property, but what happens when those government-backed loans run out? Most people hit a brick wall after their first house hack, but there's a little-known strategy that can turn a single property into 10 without needing more of your own cash. Let me show you how I went from that first duplex to owning multiple properties using what real estate pros call the BRRRR method. Here's the problem. FHA, VA, and USDA loans are amazing for getting started, but they come with a major limitation. You can only have one at a time, and they're designed for primary residences. So after you buy that first property and live in it for a year, how do you keep growing? Traditional wisdom says you need to save up another 20 to 25% down payment for your next investment property. At that rate, it might take you 5 to 10 years to buy your second building. That's where the BRRRR method comes in, and it's completely changed how I approach real estate investing. BRRRR stands for buy, rehab, rent, refinance, repeat. It's the secret sauce that lets you recycle the same initial investment over and over again to build a serious portfolio. Let me break down how it works. First, you buy a property that needs some work. I'm not talking about a total disaster that needs to be knocked down and rebuilt. I'm looking for cosmetic issues, outdated kitchens, ugly bathrooms, terrible paint colors, and carpeting that looks like it's from the 1970s. These properties are typically undervalued because most homebuyers want move-in ready homes, not projects. Next, you rehab the property. This is where you force appreciation by making strategic improvements that boost the property's value significantly more than they cost you. For example, spending $20,000 on a kitchen renovation might increase the property's value by $40,000. In real estate, this is called forced appreciation because you're not waiting for the market to naturally raise values. You're forcing it through improvements. When your renovations are complete, you rent the property to quality tenants. This accomplishes 2 crucial things. First, it creates cash flow to cover your mortgage and expenses. Second, it establishes the property as a performing rental, which is exactly what lenders want to see before the next step. Here's where the magic happens. About 6 months after you've completed renovations and placed tenants, you refinance the property with a cash-out refinance. Because your renovations increase the property's value, you can often pull out all of your original investment plus rehab costs. For example, if you bought a property for $200,000, put $30,000 into renovations and it's now worth $280,000, you can typically refinance up to 75 to 80% of that new value. So with that $280,000 appraised value, you could get a new loan for $224,000, 80% of $280,000. Your original loan was $200,000, so you're walking away with $24,000 in cash. That's enough to cover most of your renovation costs, which means you've essentially created a free rental property that generates monthly cash flow. Then you repeat the process with your next property, using the cash you pulled out from the refinance. It's like cloning your first investment over and over again. The timeline for each BRRRR cycle varies, but you're typically looking at 3 to 6 months for the buying and rehab phases, another month to get it rented, and then 6 months of seasoning before most lenders will let you do the cash-out refinance. So realistically, you can complete one full BRRRR cycle in about a year. Finding the right properties is crucial to making this work. I look for homes that meet what I call the ugly house criteria. Properties that are structurally sound but cosmetically challenged. These might be homes that have been on the market for 60+ days, estate sales, or properties with motivated sellers who need to close quickly. I focus on neighborhoods where property values are expected to rise. This gives me a double advantage. I'm forcing appreciation through renovations while also benefiting from natural market appreciation. The combination can be powerful for building equity quickly. Now let's talk about the financing piece, because this is where most people get stuck. After you've used your FHA, VA, or USDA loan on that first property, you'll need to shift to conventional financing for your BRRRR properties. Conventional loans for investment properties typically require 15 to 25% down, which is exactly why the BRRRR method is so powerful. It helps you recapture that down payment. When you refinance, lenders will want to see that you have experience as a landlord and that the property is cash flowing. They'll typically count 75% of your rental income toward your debt-to-income ratio qualification. Your credit requirements will also be stricter. Expect to need at least a 680 to 700 credit score for investment property loans. The real power of the BRRRR method becomes clear when you look at how quickly you can scale. Let's say you start with that $14,000 FHA down payment on your first fourplex. After living there for a year, you move out and keep it as a pure investment property. Then you take $20,000 from your savings or from a cash-out refinance on your fourplex after it appreciates to put down on your first BRRRR property. After completing one BRRRR cycle, you get most or all of that $20,000 back, plus you now have 2 cash-flowing properties. You use that same $20,000 for your next BRRRR property, and so on. Within 5 years, you could realistically own 5 to 6 properties using largely the same initial capital. I've seen investors start with a single property and build portfolios worth millions using this recycling strategy. One case study I love is an investor who began with a modest fixer-upper, renovated it to increase its value, rented it out, and then used the equity to purchase additional properties. Within a few years, they had built a substantial multi-million-dollar portfolio using this exact method. The really cool thing about the BRRRR strategy is that each property in your portfolio is generating cash flow while simultaneously building equity through tenant mortgage paydown and appreciation. It's like having multiple wealth-building machines all working for you simultaneously. Let me be clear though, this isn't a get-rich-quick scheme. Each step requires work, research, and some risk. The buying phase means analyzing dozens of properties to find that perfect diamond in the rough. The rehab phase means managing contractors or doing some work yourself. The rental phase means finding great tenants using the screening techniques we talked about earlier. And the refinance phase means navigating the mortgage process. But here's what makes this all worth it. Once you have a handful of properties using the BRRRR method, your monthly cash flow can easily replace a full-time income. 5 properties generating $500 each in monthly cash flow equals $2,500 per month. 10 properties gets you to $5,000 monthly. Risk management, protecting your real estate empire. That monthly cash flow can change your life. But here's the uncomfortable truth that most real estate gurus never talk about. Your growing portfolio also means growing risk. The question isn't if problems will happen, it's when. And whether you've prepared for them like the top 1% of investors do. Let's be honest for a second. Real estate investing does come with legitimate risks. Tenants can stop paying, roofs can spring leaks, and economic downturns happen. But there's a massive difference between the investors who get crushed by these events and those who barely notice them. Think of it like driving a car. Is it dangerous? Technically, yes. But do most of us drive every day without incident? Absolutely, because we have safety measures like seat belts, airbags, and insurance. Your real estate portfolio needs the same protection systems. Let's start with the most fundamental protection strategy: cash reserves. This is your financial seatbelt. Professional investors maintain 3 to 6 months of mortgage payments per property in easily accessible accounts. That means if you own 5 properties with $1,000 monthly payments each, you should have $15,000 to $30,000 set aside. I know what you're thinking. That's a lot of money sitting around doing nothing. But here's the reality. This cash isn't doing nothing. It's providing something incredibly valuable: sleep insurance. When your furnace dies in the middle of winter, or you have an unexpected 2-month vacancy, you're not panicking or maxing out credit cards. You simply dip into reserves, handle the issue, and replenish the account when cash flow returns. Now let's talk about actual insurance. Your portfolio's airbags. Standard landlord insurance policies are just the beginning. These cover basic property damage and some liability, but sophisticated investors go several steps further with comprehensive coverage. The secret weapon most amateur investors miss? Umbrella insurance. For just a few $100s annually, you can add millions in additional liability coverage beyond your standard policy limits. This protects you if someone slips on your property and decides to sue for a life-changing amount. While your base policy might cover $300,000 in liability, an umbrella policy can extend that to $1 to $5 million for surprisingly little cost. But insurance isn't just about policies you buy, it's also about how you structure your business. One of the biggest mistakes new investors make is holding properties in their personal names. If something goes catastrophically wrong at one property, everything you own could be at risk. This is where entity structures like limited liability companies, LLCs, become crucial. By holding each property or small groups of properties in separate LLCs, you create legal firewalls between your assets. If there's a lawsuit at property A, properties B through Z remain protected. Plus, LLCs offer significant tax advantages since profits pass through to your personal income without facing corporate tax rates. Now let's talk about something that terrifies many new investors: vacancies. Every month your property sits empty is a month you're paying the mortgage out of pocket. The key is understanding typical vacancy rates in your target markets and building them into your calculations from day one. While vacancy rates typically range from 5 to 10% depending on the area, many new investors make the fatal mistake of assuming 100% occupancy in their planning. Reality check. Even in the best markets, you should budget for at least 1 month of vacancy per year. That means if you're collecting $1,000 in monthly rent, your actual annual income is closer to $11,000, not $12,000. Smart investors take this a step further by researching seasonal vacancy patterns. College towns might see higher vacancies during summer breaks. Tourist destinations might have opposite seasonal patterns. Understanding these trends lets you time your lease renewals strategically to minimize downtime. But perhaps the most important metric that separates professional investors from amateurs is the debt coverage ratio, or DCR. This is the relationship between your property's net operating income and your debt payments. Lenders typically require a DCR of at least 1.25, meaning your property's income should be 25% higher than all debt obligations. But savvy investors aim for a DCR of 1.5 or higher. This means if your mortgage and other fixed costs total $1,000 monthly, your property should generate at least $1,500 in net income after expenses like repairs, vacancy allowances, and management fees. This extra buffer isn't just to satisfy lenders, it's to protect you from the unexpected. When your properties consistently generate significantly more income than they cost to maintain, small problems don't become financial catastrophes. Let me show you what this looks like in action. Imagine two investors, each buying identical $300,000 duplexes. Investor A uses every penny of available cash for the down payment, has no reserves, keeps their properties in their personal name, skips umbrella insurance to save money, and calculates returns assuming 0 vacancies and minimal repairs. Investor B puts 20% down but keeps 6 months of expenses in reserves, places the property in an LLC, buys comprehensive insurance including a $2 million umbrella policy, and calculates returns with a 8% vacancy rate and proper maintenance budget. Fast forward 1 year, a major hailstorm damages both roofs. Investor A panics, can't afford the repairs, their property deteriorates, tenants leave, and they eventually face foreclosure. Meanwhile, Investor B dips into reserves, gets the roof fixed immediately, files an insurance claim, and their tenants barely notice an interruption. Same event, dramatically different outcomes. This protection mindset extends to how you scale your portfolio too. Amateur investors often concentrate all their properties in a single neighborhood or city because it's convenient. Professional investors understand geographical diversification. When one market faces challenges, like a major employer leaving town or natural disasters, only a portion of your portfolio feels the impact. Here's another protection strategy the pros use: fixed-rate mortgages. While adjustable rates might offer lower payments initially, they introduce massive uncertainty to your long-term planning. With fixed-rate financing, your largest expense is locked in for decades, creating predictability that shields you from interest rate spikes. When you implement these protection strategies, something magical happens. Your real estate investments actually become less risky than many traditional investments. While stocks can lose 30 to 50% of their value overnight, a properly protected real estate portfolio tends to weather economic storms with much less volatility. And unlike paper assets, real estate gives you direct control over your investment's performance. You can't call the CEO of a company you've invested in and suggest operational improvements, but you can absolutely upgrade your rental units to command higher rents or implement better management practices to reduce turnover. The protection strategies I've shared today aren't sexy. They don't make for flashy Instagram posts or YouTube thumbnails, but they're the difference between building lasting wealth and becoming another cautionary tale of an investor who flew too close to the sun. Taking action, your step-by-step blueprint to get started today. While protection strategies create the foundation, they're useless if you never take the first step. Most people spend years getting ready to get ready, while others with the same resources are already collecting rent checks. Let's fix that today with a dead simple 90-day blueprint that turns overthinking into ownership. You know what's the biggest reason 97% of would-be real estate investors never buy a single property? It's not money. It's not the market. It's straight-up paralysis by analysis. They consume video after video, read book after book, attend seminar after seminar, but never actually do anything with all that knowledge. I get it. It feels safer to learn more before jumping in. But here's the brutal truth. There's a massive difference between people who talk about real estate investing and people who actually build wealth through it. The first group has perfect theoretical knowledge. The second group has imperfect action and actual properties. Let me break down exactly what you need to do in the next 90 days to join that second group and get your first property. No fluff, just action steps. Days 1 to 15. Get your financial house in order. Pull your credit report and see where you stand. If your score is below 580 for FHA or 640 for USDA loans, focus on quick credit fixes like paying down credit cards and removing errors from your report. Remember, even a 30-point boost can make the difference between approval and denial. Days 15 to 30. Get pre-approved for your loan. This is where the rubber meets the road. Choose which loan program fits your situation, FHA, VA, and apply with at least 2 different lenders to compare rates and terms. For VA loans, you'll need to obtain a certificate of eligibility through the VA's e-benefits portal or directly through your lender. The good news is this process typically takes just minutes when done electronically. FHA applicants, make sure your debt-to-income ratio is under 43% to qualify. USDA applicants, verify your property eligibility through the USDA's property eligibility page online. These small details make a huge difference in approval. Pre-approval isn't just paperwork. It's psychological commitment. Once you have that letter in hand, you're no longer just thinking about buying property. You're officially in the game. Days 30 to 45. Build your power team. This step separates the amateurs from the pros. You need 4 key people. First, a real estate agent who specializes in investment properties, not just any agent. You want someone who understands cash flow, can spot value-add opportunities, and ideally owns rentals themselves. Ask potential agents, how many investment properties do you personally own? If the answer is 0, keep looking. Second, a home inspector who will be brutally honest about property conditions. You don't want a sugarcoater when you're betting your financial future on a building. Third, a contractor who can give quick renovation estimates. This person will help you determine if that great deal actually makes financial sense after repairs. Fourth, an insurance agent who understands landlord policies. Standard homeowners insurance won't cut it for rentals. Days 45 to 75. Hunt for properties like it's your job. This is where most people get stuck in endless browsing mode. Set specific goals. View at least 3 to 5 properties per week in person. Analysis happens in the field, not behind a computer screen. When analyzing properties, use the 1% rule as your quick filter. Monthly rent should equal at least 1% of the purchase price. So if a property costs $200,000, it should generate at least $2,000 in monthly rent. This isn't gospel, but it's a quick way to eliminate obviously bad deals. For a deeper analysis, calculate the cash-on-cash return by taking your annual pre-tax cash flow divided by your total cash invested. For example, if you're putting $10,000 down and generating $2,000 in annual cash flow, that's a 20% cash-on-cash return. Way better than most other investments. You should also understand cap rate. Simply divide the net operating income by the property's market value. It's a quick way to compare different investment opportunities in the same area. Days 75 to 90. Make offers and get to closing. In competitive markets, you might need to make 5 to 10 offers before one gets accepted. This is normal. Don't get emotionally attached to any single property. To make your offers stand out, consider these strategies. Be flexible with closing dates, offer to cover some of the seller's closing costs, or make your offer clean with minimal contingencies. In hot markets, sellers value certainty over a slightly higher price from a buyer who might back out. The timeline from accepted offer to closing typically takes 30 to 45 days for FHA loans, with similar timeframes for VA and USDA loans, though efficiency varies based on your lender's experience with these loan types. What happens if you follow this 90-day plan and don't close on a property? Simple. You keep going. The foundation is laid. You're pre-approved, you have your team, you understand how to analyze deals, and you're making offers. Success is now just a numbers game. The most successful real estate investors I know all share one quality: persistence. They don't quit when the first, second, or fifth deal falls through. They keep making offers until the numbers work. Remember Jennifer? She was a school teacher who followed this exact 90-day plan. She got pre-approved for an FHA loan, built her team, analyzed 27 properties, made offers on 8, and finally closed on her duplex on day 103. Was she late? Technically, yes. But within 3 months, she went from 0 to property owner while her colleagues were still talking about someday buying rental property. Or take Miguel, who spent 2 years reading books about real estate investing. He knew everything about cap rates, cash-on-cash returns, and appreciation rates, but he owned 0 properties. Then, he followed this 90-day blueprint, took imperfect action, and closed on his first fourplex. Today, just 3 years later, he owns 5 properties and has reduced his work hours to 3 days a week. Here's what separates dreamers from doers in real estate. Dreamers wait for the perfect property in the perfect market with the perfect financing. Doers understand that good enough today beats perfect someday. The truth is, even a mediocre deal that you actually close on is infinitely better than the theoretical perfect deal that never happens. That first property teaches you more in 3 months than you'll learn in 3 years of research. What if I told you that building substantial real estate wealth isn't about having a fat bank account to start with? The truth is hidden in plain sight. Everyday people are creating financial freedom starting with almost nothing. Take Craig Curelop, for example. He began with just $17,000 as a down payment on his first property. That initial investment generated $1,000 in monthly cash flow, which he then leveraged to rapidly expand his portfolio. Stories like Craig's aren't rare exceptions. They're the blueprint that countless successful investors have followed. The secret isn't having tons of money, prestigious connections, or extraordinary luck. It's simply about understanding these strategies and actually implementing them. House hacking is often the gateway, living in one unit while tenants in other units cover your mortgage. From there, your real estate journey can snowball into something life-changing. Your future wealthier self is